The first thing I want to do is to get started is just break down the 30-year mortgage in terms of how it works. Think of this as a timeline of the 30-year mortgage. So you have year 1 and then you have year 30. Well, what happens on a mortgage? This doesn't matter if your interest rate's 3%, if your interest rate's 7%, even if your interest rate's 2.5%. What happens with every mortgage out there is that in the first few years while you make those payments, and we're going to talk about at the 7.25%, when you're making those payments, what's actually happening is that the majority of the interest on that loan is being paid in the front part of that mortgage. This is done because the 30-year mortgage is actually specifically designed that way by the banking system. And the reason for that is that typically, on average, in year 7, the majority of people do a couple of things. They either sell their home, they move, or they refinance, right? If the banks are expecting all those things to happen, they want to ensure that they get paid before that happens, right? The majority of the payments, like I said, as you're making them in the front part of the mortgage, they're going towards the interest. But there does reach a tipping point where when you make that payment, more of what you're making actually goes towards paying down the principal. Now, when we're talking about an interest rate of 7.25, that break-even point is actually around year 18. So about 18 years into the mortgage, finally this client, when they make a payment, the majority of that payment would have been going towards actually paying down the home.